Picture this, a massive construction site. Dust everywhere, cranes swinging, a colossal bridge that's only half built. Now fast forward. Rain pours, timelines get pushed back, and the cost of steel goes through the roof. You know, some projects just aren't completed in a single day. They run for years. And this long-term reality, it's a huge headache for engineers, but honestly, it's an even bigger one for us accountants.
So that brings us to the ultimate question. If a project takes 3, 4, maybe 5 years, when exactly do you recognize the profit? Do you book a little bit of it today, right as the cement is drying, or do you wait years until the absolute final day of completion? That is the core dilemma we're tackling right now as we break down AS-7 construction contracts. Let's get into it. To make this super clear, let's introduce our protagonist. Meet Arjun. He's an ambitious contractor who just landed a massive deal from the government. He's been tasked with a brand new bridge construction contract. The total contract value, a cool 10 crore rupees. The timeline? 3 whole years. Guys, this isn't your normal, everyday, over-the-counter sale. This is a massive, complex, long-term commitment.
Now, before we jump into the heavy math, let's actually define what we're talking about. According to ICAI, a construction contract is one that's specifically negotiated for the construction of an asset. So this could be a single asset like Arjun's bridge, or maybe a building, a dam, or a road. Or it could be a combination of assets that are really closely interrelated in their design or ultimate purpose, like say an entire oil refinery.
And this right here perfectly shows why standard accounting rules just don't work for this stuff. We're dealing with a process that spans over a really long period. If you used standard year-end revenue rules, your financial statements would look totally crazy. You'd have years of massive expenses showing zero revenue, and then boom, one single year of astronomical profit at the very end. That is exactly why ICAI requires the specialized accounting guidelines of AS-7.
But here's the thing, not every contract is built the same way. You've got 2 main types. First up is the fixed price contract. This is where the government looks at Arjun and says, hey, complete this project for exactly 10 crore rupees. The price is totally locked in. If the cost of steel suddenly triples, well, Arjun takes the hit. The risk is basically all on him. Then, on the flip side, we have the cost plus contract. In this setup, the government says, look, whatever allowable costs you incur, we'll reimburse you. Plus, we'll give you a fixed percentage on top as your profit margin. Here, Arjun's risk is way lower, and his profit is pretty much guaranteed.
Okay, quick pause. If you are studying for your exams right now, listen up, because this is a massive ICAI exam point. You absolutely need to remember who holds the risk. Fixed price, the contractor bears the cost escalation risk. Cost plus, the contractor is assured a profit margin no matter what happens to material prices. Examiners literally love to test you on this specific structural difference, so lock it in. All right, let's jump back to Arjun. His bridge is currently half built. Construction is moving along, but that big question is still hanging over our heads. When exactly do we recognize the profit on his income statement? I mean, do we just wait? Do we take a wild guess? Let's look at the rules. Historically, there were 2 ways to handle this. The old way was the completed contract method, where you'd only recognize profit after the project hit 100% completion. But honestly, that method is totally outdated now, and AS-7 explicitly rejects it for standard use. Instead, we use the newer approach, the percentage of completion method, or POC. This right here is the absolute core of AS-7.
And the logic behind POC is actually really elegant. It perfectly lines up with the fundamental accrual and matching concepts we know and love in accounting. The rule is incredibly simple. The more work you actually complete, the more revenue you're allowed to recognize in that specific period. It makes sure that your financial statements reflect the true, real-world progress happening on the ground year by year.
But how do we actually measure that progress? You can't just eyeball it and guess. AS-7 gives us 3 approved ways to figure out the stage of completion. Number 1 is the cost-to-cost method, which simply compares the costs you've already incurred against your total estimated costs. Number 2 is relying on actual surveys of the work performed, usually certified by an expert. And number 3 is measuring the completion of a physical proportion, like counting the square feet of road actually laid down. Now, for exams in the real world, cost-to-cost is definitely your go-to method.
Let's do a quick calculation so you can see exactly how this works. Let's say in year 1, Arjun incurs exactly 3 crore rupees in construction costs, and he estimates that the total cost for the whole project, from start to finish, will be 10 crores. Under the cost-to-cost method, we just divide that 3 crore actual cost by the 10 crore total estimated cost. Boom, that gives us 30%. So his project is officially 30% complete. Now we just apply the magic formula. Since the project is 30% complete, Arjun is allowed to recognize 30% of his total contract price as revenue for that specific year. His contract is for 10 crores, so 30% means his recognized revenue is 3 crores. And to find his profit, we just take that 3 crores of recognized revenue and subtract the 3 crores of actual costs he incurred.
See how that works? The profit is recognized incrementally. It's like watching a progress bar slowly fill up over the 3 years. You get to recognize a partial profit every single year. It's smooth, it's gradual, and it perfectly matches the actual physical construction of the bridge. This totally avoids those crazy, misleading profit spikes in year 3.
But hey, construction is never that smooth, right? Let's throw a massive twist into Arjun's story. Out of nowhere, an unprecedented storm hits his site. Equipment gets wrecked, timelines are completely thrown out the window, and there's just total chaos. Suddenly, nobody has any idea what the total costs are going to be. The outcome of the contract simply cannot be reliably estimated anymore. So, what does an accountant do now?
Well, when uncertainty hits like this, AS-7 gets really strict. If you can't reliably estimate the outcome, you hit pause on the percentage of completion method. Instead, you trigger the uncertainty rule. This means revenue is recognized only to the extent of the cost incurred that you actually think you'll recover. So if you spent 2 crores, you only recognize 2 crores in revenue. And what does that mean for profit? It drops to absolute zero. The ICAI logic here is rock solid. Absolutely no profit can be recognized until certainty returns to the project.
Okay, so the storm finally clears, but Arjun realizes his absolute worst nightmare has come true. The damage was so bad and replacement materials are so incredibly expensive that his expected total costs have ballooned up to 12 crore rupees. But remember, the government is only paying him a fixed 10 crores. This means no matter what, the overall project is guaranteed to result in a 2 crore loss.
And this right here brings us to the most uncompromising absolute gold rule of AS-7. The moment you identify an expected overall loss on a contract, you must recognize that entire loss immediately as an expense in your P&L, period. You don't spread it out over the remaining years, you don't wait and see. Under the principle of prudence, expected losses can never, ever be delayed.
Real quick, before we finish Arjun's story, let's look at how this all sits on the balance sheet. The costs you've incurred plus your recognized profits, that becomes your work in progress, or WIP, which is categorized as an asset. Meanwhile, the amounts you've actually billed to your customer, known as progress billings, act as a liability, and you deduct those from your WIP. It's a really neat way to balance the physical sweat you've put in against the cash you've requested from the client.
3 years later, against all the odds, the storm is a memory, and Arjun's bridge is finally complete. Cars are driving over it, the dust has settled, and because of AS-7, Arjun's financial statements accurately told the real story of that journey year by year. Profit and, yeah, in our twist scenario, the losses too, were recognized alongside time and progress. They weren't just artificially dumped onto the very last day.
All right, let's lock this in with a super fast revision. If you're studying, literally take a screenshot right now. Types of contracts, fixed price and cost plus. The core accounting method, percentage of completion. How do we measure the stage? Usually, it's cost incurred divided by total estimated cost. Profit gets recognized gradually. If the outcome is totally uncertain, zero profit. And if you foresee an overall loss, you recognize it immediately.
You know, this entire standard really just boils down to one simple philosophy. A true accountant is the one who reveals the truth alongside the progress. Accounting isn't about hiding reality until some fancy ribbon-cutting ceremony. It's about reflecting the real-time economic substance of the hard work happening out there in the dirt and the rain. And that officially wraps up our explainer on construction contracts. But I want to leave you with one final thought. If AS-7 relies so heavily on estimating total costs in a totally unpredictable world, does accounting ever perfectly capture reality, or is it really just trying to tame the untamable? Let me know what you think down in the comments. If this explainer helped you finally master these concepts, please hit that like button, share this with your friends, and comment next AS so I know exactly which standard to conquer next. Keep learning, keep progressing, and I'll see you in the next explainer.